This is Satya Pradyaman of Cirrus Research. Our quarterly outlook report, The Dispatch, has just been released. The title of it is Quality Bet Amplifies as the Capital Markets Tighten. A lot of this has to do with the shift in the focus in the credit markets in just the last few weeks, the closing of March. We had a record hiccup in the stock market, especially smaller stocks had been severely punished. And what we're now looking at is a window in which the capital markets have begun to tighten as the Fed starts to potentially step back. This chart here underscores why the house view remains firmly anchored in a higher quality stance. The chart you're looking at represents the outlook of top line growth as it's just beginning to slow, and the forecast on earnings expectations. As much as it's been fading the past year, it seems to us that these numbers are still too benign, so we expect them to fall further. In addition to that, what we've also seen is this market for over the last year and a half has begun to really make a shift towards higher quality in most of the key sectors, the exception remaining the commodity groups, potentially for obvious reasons. This liquidity reading remains in negative territory. We expect this to continue to really add downward pressure on market multiples, even as profitability is likely to drive markets higher. This is a more close-up of the earnings expectations data we're modeling. And the idea is that if you are a contrarian, you're looking for the big buy on equities, these forecasts that we're looking at, especially with the recent fallout with the capital markets, seems to us that they will be going lower. This coming earnings season will likely really reflect a lot more downward guidance than we had originally thought. Looking at the credit markets and the fallout explicitly, not just in high yield, but in the subcomponents, especially in financials and housing, what we saw in March was a very difficult moment where credit spreads really blew out several hundred basis points in some cases. What we've seen since then, as the Federal Reserve had stepped in, is that we have seen some stabilization in those rates. There are certain areas where we have seen sort of a rebound in those spreads, but clearly financials remain fairly inflated. This is a new model or indicator we've come up with, fairly straightforward. It's a look at banks that behave like SIVB. So the idea is that what we want to look at is that if the March event was an earthquake, what are the aftershocks? What are the likelihood of seeing additional moves? So this is one proxy for banks very related or correlated to SIVB versus the opposite end of the bank universe. And what you'll notice is that the banks did sharply underperform. The SIVB correlated banks sharply underperformed through the bank funding period. And then somewhere about mid-March, we started to see a stabilization of those two tail baskets. So we do think this is encouraging. Again, it's not just one indicator, but the idea is to continue to look for aftershocks as we really progress through this quarter. Ultimately, though, this idea about earnings visibility will probably anchor the portfolio as we progress through the next couple quarters. Feel free to call us for any question. Also, please feel free to join us for our upcoming conference call. The details are included in the message. Thank you.